and go to chapter 9. We covered 8 already. So go to chapter 9 and do some exercise problem, which help you also to do your homework assignments anyway. So here are exercise right there. Okay, for chapter 9, yeah, you have about 10 homework assignments, maybe problems, maybe. Okay, let's do one by one anyway. So here, can do a few of those today. So the company is planning a budget for May. Planning budget for May. It's already provided to us. Diving hours are 100 hours. Planning budget. Revenue will be based on $365 each times an hour of 100 hours, so that will be $36,500. We have some expenses, wage and salaries. They have a fixed part and they have a variable part. Supplies, they have a variable expense. Equipment rental, they have fixed expense and some variable. Insurance is always fixed, looks like. Miscellaneous, they have some fixed expenses and $1.80 per hour of diving hour. That's a variable. Okay, but this is the planning budget. It says during May, the company actually was having 105 diving hours. The planning was about 100, but the actual situation was 105. So you need to see, how did you do good or no? But in order to understand if you did good or bad, you need to create a flex budget in order to compare apple to apple, right? You cannot compare 105 hours to 100 planning hours and say, oh, we did good or we did bad. No, you have to convert this planning budget, this to a flex budget. So this is a static budget, 100 hours estimated, but you have to convert it to flex. And I have the answer here for you. So to create the flex budget, you have to change the hours to 105. That means revenue will be $365 per 105. That is $38,325. Expenses, whatever is fixed, but the variable will change. Like supplies, again, it's completely variable. Equipment is 1,800 plus variable per hour. Insurance is fixed. Miscellaneous has some fixed part and some variable. So you add them up. The net operating income will end up being $7,506. And if you look at your so-called static budget was $6,490, but you look at your flex budget, you should have how much? $7,506. So that's a flex budget. But when you have a flex budget, then you have to compare your flex budget to your actual budget. So in problem number 2, we are doing that. So this is our flex budget, and then we compare it to the actual results, and then we see if we are doing good or bad. So in problem number 2, which is again probably a homework assignment, it says the company harvested and sold 8,000 pounds of oysters in August. The company flex budget for the August appears below. Here is the flex. It's already given to you. In previous problem, we created a flex budget, but in this problem, they gave the flex budget already. But then they say the actual results for August are below. This is the actual stuff happened. So now you as a manager need to calculate the company's revenue and spending variances for August and try to understand a little bit more about these issues. So here we are trying to compare them. So the actual is here, the flex budget is on the right-hand side. Now you compare and you say, okay, the flex is showing exactly same as actual. That's very nice. Now we are comparing apple to apple. So in this regard, you see the revenue has been increased by $3,200, which is a favorable situation. Packing supplies actually was for the $200 cost, but based on flex budget, it should have been only $4,000. That's a $200 unfavorable situation. Oyster bed maintenance, it ends up to be $3,100 cost, but the flex budget shows $3,200, so that's a good thing. We have $100 of less actual expenses. That's a favorable. Wage and salaries, same thing. It's a little bit more than flex. That means unfavorable. Shipping, it's more than flex. That's unfavorable again. Utilities are less than flex. That's a favorable saving. We are good. Other expenses, it's more than flex, and that's 130 unfavorable. So now you add all these expenses, you end up to be, as you see, in an unfavorable situation in regards to expenses. However, expenses minus 3,200 favorable revenue gives us still 2,100 favorable more income, and that's very good, right? That's what you like. Of course, as a manager, this is a good thing, but as a manager, you're going to focus on these unfavorable situations. You like to learn and see how you can change these unfavorable situations to make them favorable. And if you can do that, your bottom line net income will be much, much better than whatever it is right now, but still is good, not bad, but you have room to improve, right? Okay, so let me do number 4 this time. So in number 4, I think direct material variances. So the company during the quarter ending June 30th, the company manufactured 3,500 helmets using 22,500 kilograms of plastic. The plastic cost the company $171,000. So this is the actual data that happened. Okay. So we produced 35,000 helmets. We used 22,500 kilograms of plastic, and the cost was $171,000. According to the standard cost for the company, each helmet should require 0.6 kilogram of plastic at the cost of $8 per kilogram, and that's the direct material, right? Okay, so what is the standard quantity of kilogram of plastic, standard quantity that is allowed to make 3,500 helmets? What is the standard material cost for 3,500 helmets? What is the material spending variance? And what is the price variance? Okay. Let's look at the solution for a second to see how that goes. So number of helmet produced is 35,000. 0.6 kilogram of plastic. That means we have to use 21,000 kilograms of plastic. That's what standard usage should be. And the cost for 21,000 kilogram times $8 standard cost, the cost has to be 168,000. However, the actual cost was 171. We know the standard is 168. And that gives us $30,000 unfavorable material spending variance, right? And you might say, okay, perfect. So what is the problem? The issue is you cannot say what is the problem. You know that $30,000 is unfavorable spending variance in regards to material, but you don't understand why there is a problem, where the problem is coming from. In order to know where the problem is coming from, you have to do some surgery. You have to deep inside and go and look, see where the problem is coming from. Okay? So how do you do that? I'm going to teach you a simple way so you don't forget, okay? Look at this picture for a second. How do you create this in the middle of exam and kind of remember how to do it and remember how fast to do it and don't waste many minutes to get to the final results. So listen to me carefully. In order to do this, just take a small space in your notepad and do this. A. So write AAA, okay? A. Okay? And then write after A, then write S. So let me show you on a piece of paper so you can kind of understand what I'm saying. You will see it's not a big deal. So this is how you do it. AAA, got it? Triple S. AAA, triple S. That's the first thing you do. Then you start with quantity, price. Quantity, price. Quantity, price. And then attach these two, the other two, and the other two. Multiply. Got it? That's it. QP, that means quantity price. Q means quantity, P means price. So this is actual quantity, actual price, actual quantity, actual price, standard quantity, standard price, right? But one more time, how do you do it? You write AAA, triple S, QP, attach. Got it? And then you enter those information in here right below, and then you multiply. So you enter information in here, there, and then you multiply. You get the answer here, and here. And then you compare these two, and then you compare these two, right? And now let's look at the picture, the solution on the solution manual so you can understand it. But all I want to say is QP, AAA, triple S, SSS, QP. That's it. Got it? So remember that. Let's go back. Okay, so here is AAA, 1, 2, 3, triple S, 1, 2, 3, QP, attach. Now, let's see. So the standard quantity was 21,000 kilogram, right? standard price was $8. So 21,000 times $8 is 168. Actual quantity was 22,500 kilogram purchased, which it's provided in the by management to us. And standard price, we know it's $8. So 22,500 times standard price of $8, that's 180. Actual quantity times actual price, they told us already that they spent 171,000. So we don't need to calculate that. I know already it's 171,000 spent. So I don't need to multiply. So don't waste time in here because the results are already given. Just move on. Okay, now compare these two first and then compare these two, okay? Now let's listen to me carefully how I'm comparing. In this group, standard price and standard price is the same thing, right? So what's the difference? The difference is quantity, right? The difference is quantity because price is here says standard price, here says standard price. So we call this material quantity variance. 168 should be standard, right? SS. You see here it says SS, SS. Standard, I was supposed to spend 168. Actually, I spent 180. So 168, I was supposed to spend minus 180. That gives me $12,000 unfavorable situation because my SS standard was 168,000, but actually I spent 180. And that's material quantity variance. But now let's look at these two groups together. In these two groups, actual quantity and actual quantity is the same. So what's different? It's here, the price is different. You see, the price is different. Here is actual price, here is standard price. So this is material price variance. In material price variance, this is how I explain. Actually, actually, I spent 171,000, but based on standard cost, it should be 180. So actually, I spent less than standard. So that's a $9,000 favorable material price variance, right? So I spent less, that's material price variance, $9,000. So far, so good. Now you compare these two. Material quantity variance is 12,000 unfavorable. Material price variance is 9,000 favorable. So 12,000 unfavorable minus 9,000, that's $3,000 unfavorable. And that's total spending, total material spending variance, total material spending variance of $3,000 unfavorable. So now here you might say, yes, it's $3,000 unfavorable, but I got the same results here. But because I did this surgery, now I know exactly where the problem is coming from. The problem is not the price. Price, we did great on this. The problem is the material quantity is unfavorable. That means the material has such a low quality that we end up end up using so much material that does not justify the $9,000 saving on the price. So if you talk to purchase manager, he will tell you, I did a great job. I saved $9,000 on material price compared to standard cost. But the production manager will say, yes, you did it, but the quality of the product you bought was so low that is not justifying your judgment in buying this material with $9,000 favorable situation, because we end up by spending $3,000 unfavorable overall total material spending variance, right? So it's not about the price, your price is good, but the material is quality is so low, don't buy it again. So if you don't do this surgery, they don't understand what to do and where is the situation root result coming from, where the problem is. So you have to do a surgery variance analysis like this. We call it variance analysis. Variance analysis in order to understand where the problem is coming from. Got it? Since this is going to be recorded, you can just listen to my recording one more time so you can learn how to manage to do all this in 1 minute. Just 1 minute, that's all you need. AAA, SSS, QP, QP, QP. Plug in your numbers, do the math, figure out what's the material quantity variance, what's material price variance, and what is spending variance. As soon as you do this, you can answer anything in the multiple choice question. So I suggest as soon as you get a question like this, either in my class or in a CPA exam, just get this done. It takes you 1 minute. After 1 minute, you can answer any question that the question is asking because you have all the information right in front of you. Okay? Okay, so I like to do one more just to see this one also. So this is about, I believe, direct labor. So in this problem, number 5, it says the number of meals prepared are 4,000 meals prepared. Standard direct labor hour per meal preparation is 0.25, and standard labor hours allowed are 1,000 for 4,000 meals prepared, right? And because it's 1,000 hours allowed and your standard cost for the company is $19.75 per hour of direct labor, so your direct labor cost should be $19,750 standard. However, when you look at the actual cost, you see that they spend $19,200. Standard was $19,750. That means you have total labor spending variance of $550. So far, so good, right? You are happy with that. But you want to also do a little bit more surgery, do more analysis, variance analysis, to see where exactly this 550 favorable situation is coming from. So what you're going to do is this: AAA, SSS. Because it's about labor, instead of saying QP, you say hour rate, HR. HR. So one more time. AAA, 1, 2, 3. SSS, 1, 2, 3. HR. Draw a line and then start plugging in your numbers and multiplying. So 1,000 hours standard rate is 1975. So 1,000 times 1975, this is 19,750. Actual hours was only 960. It was given to you by management. But standard price is 1975, so it should be 18,960. 960 hours, actual hours, and the total labor cost was 19,200. They might not give you this $20 per hour, which you don't need it anyway. All you need to do is just make sure you have this number, which is again given to you by management because they know how much they spent for the labor cost. So that number, you just plug it in. And now you look at this situation. You say, wait a moment, in this left side, standard rate, and on the right side, standard rate is the same. So rate is the same. So what is the difference? The difference is in hours, actual hours and standard hours. So if your labor have more or less hours used for the same job, that means your labor is either more efficient or less efficient, right? So we call it labor efficiency variance. Labor efficiency variance, that means they used either more hours or less hours to do the same job. So that's a labor efficiency variance. Rate is the same, hours are different. Okay, so labor efficiency variance, 19,750 is the standard. SS standard was 19,750. Actually, it was 18,960. That's $790 favorable. So labor efficiency variance was awesome. That means your labor are so good and so fast, and your efficiency variance for the labor is so high, $970 favorable. However, look at here, AA. Actually, you spend 19,200. Actually, you spend 19,200, but standard was supposed to be 18,960. So 19,000 minus 18,960, you spent too much. So that's 240 unfavorable. 240 unfavorable, and that's labor rate variance. That means you paid a little bit more to your labor when you hired them, and that's a higher labor rate variance of 240, which is unfavorable. But in general, combine these two, 790 favorable and 240 unfavorable gives you still $550 total labor spending variance of 550, and that's a good news, right? So if you are in a management meeting and you are talking about this, you will mention that, yes, even though we spent a little bit more for our labor force, but our labor force are so knowledgeable, so fast, so efficient that we end up by spending, having a total spending labor variance of just 550 favorable, even though our rate was high. So you're gonna probably in your management team say, this is perfect, even though we pay sometimes a little bit more to the rate, labor rate, but it's the efficiency variance is so high that will justify that higher pay to labor. Make sense? Okay, so I solved already a few things that I want you to get the idea. Definitely read your book again, and I have my PowerPoint lectures also recorded for you if you like to listen to that. Okay, don't forget to take your exam too. If you have any questions, stop by on my office hours. Bye-bye.